live events today. We're talking everything from what's going on with oil to obviously what's been happening on the stock markets, and maybe more importantly than all of this, the volatility and where it's set to go. We'll be going through quite a few different pairs and of course discussing kind of the macro environment as well as the technical analysis, and more importantly we'll be breaking down some of the things that we've been seeing in terms of reports for the last couple of sessions. I hope you're having a great day. My name's Thomas Atkinson, and as always we'll be going through the S&P, the currencies, commodities, and obviously cryptos. We'll start off here, guys, with the big one, which is obviously oil. What a 24 hours it's been in terms of market action, and obviously what a couple of days it's been in terms of just general overall movements. You guys can see here pretty clearly that we've had a fairly large movement on oil, well, to say the least, and it went all the way up to a very big technical level. Now, one of the things that we often see here is that no, well, we got no sound. We got sound now, guys, just to make sure. Sorry, guys, if there's anything wrong with the sound. I'm just kind of resetting it here. Trish, you got sound now? I'll just answer this question here while I wait for someone else can just put in the comment section, make sure it's all working. Since we're clearly in a news-driven market cycle, two values to follow as an anchor. What one or two values as an anchor can we follow to look at future price? It's a good question there from John. We'll take a look at that in a moment. So I'm going to assume it's all working, guys, based on the fact that no one else has kind of said it's a problem. Maybe just refresh the stream. All right, let's quickly go over here and have a look at what's been going on. The big news is, of course, that oil, both UK oil, Brent, and US oil both hit into 120. And it really does go to show that technical levels can be reached pretty cleanly when it comes to markets. So you can see here that we hit 120 and we saw a massive fall off, and this is a mixture of incredible leverage and incredible call volume as well. So there's been a lot of options over the last 24 to 48 hours that have gone through in terms of market opens, and we've seen the volatility hit those. Now, this is the type of pair that you want to stay away from a little bit more because of this volatility. So often people say vol is great for trading. It can also amplify your losses as well. So when you're looking at US oil, you're saying, what is this? This, of course, has it hit a technical level? Has it pulled back to the last previous resistance? And in answer to that, you'd have to say yes, because these were the two major levels. You hit this zone. Obviously, if you break that, it becomes more likely that you're going to hit 110, 120. That's exactly what happened. So technicals kind of did work out in terms of what you're seeing on the charts here. Now, to answer John's question, there are multiple things that obviously you can look for in a news-driven market, but realistically, I still think that keeping to the technicals is super important. So let's load up US 500 for a moment here on the Pepperstone charts, and you'll notice that we have a pretty critical level that was reached yesterday between 65 and 6600. Now, what we'll do is we'll go through a really simple step. I'll just get rid of these lines here so you don't have to see them, but the main thing is that you want to be kind of keeping stuff consistent. So what's a really simple strategy that you can use in times of uncertainty? Well, you can go back through and say, what is the simplest approach to markets? And often when you first come into technical trading, you'll use what we call moving averages. Now, moving averages, we have both, of course, the 20 and the 50 on this chart, the 20 being the red one, the 50 being the blue one. And you'll note here that we have, of course, critical levels when it comes to the market. So, you know, super critical levels coming in here from the markets at two different zones. And this is exactly where you want to be, I would say, like looking and paying attention to, you know, what's happening at these areas. Now, you might say, why is that? Well, if you go through history, you'll notice that often when the 20 is taken, that is the 20 moving average is hit, it often bounces because it's what we call mean reversion on the weekly. And then once the 20 is gone below, often it will bounce up to the 20, and there may be problems around that point as well. So generally the 20 kind of goes to the 50, and if it does bounce up earlier than that, when it hits the 20 again, it often acts as dynamic resistance or support. So if you go back through history, you'll see this happening a lot as the market kind of goes up, again, loses the 20, goes to the 50. That's pretty classic, 20 the whole way up here, nice bounces, and you can see how well the 50 manages to hold price. Now, a lot of the breakdowns past that point often hit what we call the daily or the weekly 200 or the daily 200. So we want to be looking at those levels as well. So you can see here 50, 50, 50. It's a very classic one. So super simple, but does tend to work pretty well. So last 24 hours, we saw a bounce that a lot of people wouldn't have expected. and that was that market came up and hit 6,800. So if we're using good old-fashioned basic technical analysis, then we would pretty much be driving into the smaller timeframes and having a look at how the market reacted. So if we look at the market, we can kind of see here around this this daily closure level of 6770 to 6800 was pretty much where we previously had a lot of support. The market continues to buy off that, and it had problems with 7,000. So 7,000 being the critical resistance. And what tends to happen is that if a market does do a relief rally, which it certainly has, obviously the markets have shrugged off, I guess, some of the concerns and bounced over the last 24 hours, they tend to spike back up to where the market dropped a key level. And what I like to do in these analysis points is both look at the futures market or the CFD markets, like we're doing here with US 500, and I also like to look at the SPX. So we'll load up the SPX, which is just the market trade during the actual session. And what we'll notice is that we have a 2050 cross to the downside, the first time it's happened in a while, and we have pretty clear lines between around 6,800 and 7,000, which gives us a 200-point range. Now, generally speaking, the reason you want to use these is because when that happens, then you can extrapolate out what you think might occur if the market breaks down. You would have noticed that after it broke down on the Monday session, we actually hit to 6,600, and then we found some buys. Now, why is that? Well, it's the completion of what you would call a standard range on these markets here. So obviously that's the expectation there. Now, if we go to smaller, actually the weekly for a second here, you'll also notice that the weekly 20 moving average hits at around that 6,800. So again, when technicals, you're looking at this and you're really looking at the reaction around this point. So if we go back to the US 500 for a moment, because during times of uncertainty, one of the most important markets to look at is the biggest stock market in the world. And we want to see how it's reacting to key levels more than pretty much any other stock market generally. Then we want to see how it reacts around here. So small time frames such as 5 minutes, 3 minutes, 2 minutes, all of those types of ones, they become really important when it comes to these levels. So yeah, this is the type of thing that I often look at, and around this area now, I'll be paying a lot of attention. I'm sure you guys will too, to price action. So if we see stuff like, you know, a consolidation followed by a breakdown, then that could suggest that sellers are starting to put risk back onto the markets. If it manages to hover around this zone for a long time, kind of, you know, does this, kind of falls off a little bit and then starts to break up, then that suggests that the market is actually shrugging off most of the risks and could move higher. So that's the kind of thing that I'm always looking at when it comes to these charts, and I'm paying quite a lot of attention to it. So certainly something that we're looking at here. And to really answer that question, it's two basic techniques: moving averages, and whenever you see this type of vol, we want to move back. So we want to basically go back to the basics, and the basics tend to bring us to the moving averages, what's happened in the past. Because you've got to remember, we do see a lot of uncertainty throughout markets over decades, and these just tend to be levels that are respected by algorithms or respected by positional buyers or whatever else. We do tend to see these levels kind of hold up. So that's why we go back to basics, back to the number ones. The other thing that we want to look at is probably things like the number one stock in the world, NVIDIA, and we want to ask ourselves the question, has NVIDIA actually changed trend? So I asked that to you guys right now in the chat that is here. By the way, if you're watching on YouTube, like in a replay, make sure to subscribe to the YouTube channel, and make sure to obviously hit the bell icon as well. It does help us out to continue to produce this content. And you can see here that NVIDIA, if we're looking at this, we can kind of see, yeah, we've got a market that's ranged, but this 170 level seems to be kind of a critical support. So did we break below that over the last 24 hours? That's a question you're always wanting to ask yourself. And in this case, of course, we didn't. So we didn't break below that level, which means that we didn't really lose probably arguably the most important stock in the world and the most important trade concept in the world, which for the last couple of years has been hardware and AI. So AI is still holding up. It's important to bring yourself back to this, because as we often say, if it's in the press, it's in the price. Certainly the last 48 hours, particularly the last 2 weeks, have been incredibly scary when you're reading the news, and therefore you're going to have generally some kind of bias that's approached by that. when we go to look at the charts, we actually see what the flows are doing. And I think that's a really important factor for traders and investors right now to look at the charts. Now, I mentioned before semiconductors, that's also an important one. And again, you want to be looking at the higher time frame semiconductors. So you'll notice here, again, the 20 moving average, we go back to these. Again, when volatility comes in, you want to go back to basics. And you can see here that 20 moving average was hit over the last 24 hours. And then it found a bit of a buyer. Now, why does that happen? Well, again, this is where you tend to find support, and it makes sense that there's going to be some bid buying even in times of fear. So we've kind of got the stock market here bouncing up. Now, a lot of people call this what they call in technical world a dead cat bounce. That is a volatility bounce that is based on a huge movement in the markets, and obviously we end up getting that represented on the charts, and it's kind of like a relief rally. So the question is, are we hitting that? And I think the answer is going to be, what does the stock market do right here around that 20 weekly moving average? This is going to be where the bears, if they're going to show themselves, re-show themselves. So I wanted to do another little bit of analysis here. Now, most people aren't aware of this chart. This is what we call the VVIX, which you can get inside of the TradingView platform. Of course, if you connect Pepperstone to it, that'll help out. And you can see here that we have the volatility of the VIX. Now, the volatility of the VIX is pretty important zone because what this shows is that the underlying volatility of the volatility. So if you're familiar, the VIX is pretty much known as the fear gauge. This is kind of like the modern day fear gauge. So it's actually the volatility of that. And in this case, when you hit 140, you can actually overlay the S&P onto it, and you can kind of start to see how it reacts to these periods. And you'll be surprised that when you see these massive spike ups in huge VIX spiking like we have here, that it often corresponds with periods of a little bit of consolidation or even a slight rally in markets, like a relief rally. It's basically the market gets so fearful that that's what happens. And you can do that again by just loading on your charts the VVIX, and then of course going to the 140 level. It's a very interesting zone, and maybe it could be something that you have a look at after today's stream. So volatility of the VIX. If we actually look at the VIX itself, we're going to see that it went up above 30, which is pretty unusual. It doesn't happen that often, but again, when it does, it's pretty common to get rejected above the 30. And it often does show the peak fear in the market is coming in. Now, can it go higher? Of course it can. We've seen periods such as 2020 where it went astronomically high. And these usually are where you've got a sell everything style market, basically a market that could be seeing contagion. So the VIX is also showing us whether there's contagion in markets. And at this stage, I guess you would say that we don't have, at least the market doesn't think there's contagion. Some other good reads to look at in times such as this from the macro perspective, you want to be looking at bonds. High yield junk bonds are often considered a risk amplifier. At this stage, we saw a bounce. So again, the markets, for whatever reason, have managed to hold themselves up over the last 24 hours. You can see here a bit of a bounce. And then, of course, if we go to the corporate bonds, you can see again, holding their own around this key level. So yeah, pretty key stuff. Obviously, key levels, certainly something we're looking at very, very closely. Let's continue though through the main pairs, because obviously we want to see all the main pairs. First up, a lot of people think that gold is incredibly good during these times because it's kind of seen as a safe haven. Well, again, back to basics on gold. What have we got? We've got a 20 daily moving average in this case that seems to have found quite a lot of buyers in the past. And at this stage, gold is holding those zones. So yeah, I mean, again, it's kind of just showing you the representation of the basic technicals holding up. Smaller time frames, sometimes this isn't, if the setup's not there, it's not there even during times of volatility. So I think also I often say patience, react, don't predict. Gold's a bit tough because some people say, well, look, it looks like a double bottom. We break this level here, then we're probably moving to the upside. That's possible, but it does just kind of look like it's barely holding onto the daily 20 at this stage. And it's very similar for silver as well when we're looking at it on the charts. So we've got to be kind of paying attention to those things. The other ones, did we see a lot of cross correlation? So how many other markets have hit key levels of support? So here we have the Chinese market, which came down to the 50 weekly, which again, if we use times of kind of, extreme volatility as a bit of a read, then what we can do here is we can kind of see, well, what's happened in the past around the 50, and the 50 has bounced, It's gone up, it's collapsed back into the 50, it's found buyers, and then it's collapsed back into the 50 just recently. So we've kind of got that, you know, slight relief rally that's coming off this low. That makes sense as well when you consider stock market in the US hit 6,600. Chinese market here is hitting a key support. And then of course, if we look at the Australian market as well, it also hit a key level of support. So you're kind of getting that slight, what we call cross correlation. So again, in times of, I guess like, you know, uncertainty, we often look for cross correlation. And that's something that I really believe is quite powerful when you're looking at these charts. So again, that is happening here when we look through it. Now for currency traders, usually when you see uncertainty, you tend to see dollar spikes up. So this is the US dollar index, and basically we've got here what could be a basing formation Wyckoff. So generally speaking, Wyckoff, if you're familiar with it, ends up creating what we call a long-lasting accumulation or distribution. And in this case, it could be an accumulation, especially if we break through that 130 level. And you'll notice here, guys, that basically we have here a series of lower lows, and then it went just underneath where a lot of people thought the dollar was breaking down. It started to push up. And the reason the dollar goes up is because in times of uncertainty, we tend to see safe haven demand, and often people consider the, I guess you'd say, the world's currency, which is the US dollar currently, a safe haven. So that can push up yields as well, and then it becomes, you know, I guess a little bit more desired by the market. So in times of this type of stuff, we see illiquidity kind of being a problem, and therefore people go and they hunt for cash. So that's why you're getting a bit of dollar strength, but you'll notice it hasn't broken that key level. So still undecided about, you know, which way are we going to go? We're going to go to fully risk off, which may be the 130 plus, or are we going to go to, you know, continue on and risk on, even in the light of everything that's going on in the oil markets? That is generally the kind of key levels you see on the charts. So we've got oil has spiked up and got collapsed on. That is definitely leverage and liquidations and everything at work. We have Magnificent Seven stocks holding up as best they can. And we obviously have a movement of markets back to safe haven demand, which we can see here in the dollar. And if we actually have a look at emerging markets, you can kind of see something similar. Drop-offs here in the iShares Emerging Market Index. We also have drop-offs in the KOSPI, which is the South Korean market, which you can see really got, I mean, that actually went straight into a bear market, almost 20% from the top, and the Nikkei also down pretty strongly. So it was a clear risk off around the world over the last kind of week as we saw this. Now, what about the small time frames? What are you going to be looking for? Well, you're generally going to be on the smaller time frames. We'll just use Bitcoin as an example here. You're going to be looking for bids or sells. Generally speaking, you want to be kind of going in the direction of trend, and you want to look at them at critical levels. So like we saw with the US 500, we're watching this zone very closely from a technical level because it's right where you would expect a reaction to occur. Now, if we have a look here at Bitcoin, you can see here that we have a pretty interesting level of demand. And yeah, I mean, it's effectively that key zone where you're going to be looking at this and saying, all right, well, are we seeing the reaction that gets the bulls involved or the bears? And what we do know is it's a key level. So the market is clearly going between two types of people. There's still sellers out there, and there's still buyers. We're seeing volume elevated. So you want to go into small time frames and generally say, well, are we in a range? The answer is yes at the moment. So you want to be very, very quick, I guess, with your transactions, unless you're looking at it as some kind of accumulation base. So if we look at the last 24 hours, what we can say is generally markets will move into some form of safety or some form of sold asset, that is sold down asset or undervalued asset, and they'll often move out of the higher risk, higher growth assets during these times. And that's kind of why Bitcoin may be holding a little bit better because of that phenomenon. We also see that we would want to put on things like a fixed range volume profile through this work, and that we get a lot of transactions through this zone. So basically anything in here is kind of at the moment you would consider in this price range anyway, around fair value or equilibrium of the market, and anything on the upper side, so the 72,000 side, or the lower side is kind of like the outliers. So where do you expect the strongest reactions? When you do analysis like this, generally you will expect the strongest reactions on the bottom or the top, and in the middle zone, you got to be a little bit careful. That's where, you know, the markets will often chop up and down and things like that. So often as traders and investors, you're looking for price to explore areas that are a little bit more extreme, so that you can get faster reactions or better reactions there. So at the moment, you'd have to say Bitcoin's kind of at that fair value, at least based on the current range that's been had. So they're kind of the main things we're looking at in the markets right now. To really simplify it, it's very, very tough if you're trying to watch just something like oil. I think the last 24 hours would probably have shown most people. One of the good reads that you can always look at, and I think not enough people do, is when you're looking at oil, remember an oil contract like US oil is a mixture of oil contracts. So it's basically a mixture of short date and long date oil contracts, generally more short date weighted. So if you actually go CL and you push out to something like October of this year, you'll notice that the price of oil is actually very different. So the current price of a barrel might be sitting at, let's say, $87 according to the latest market. And you know, this barrel definitely went up to 80 yesterday. It's now down to 70, but it never hit the 120 that we saw in the short date contract. So what that's suggesting in the markets is that this concern could be short dated. And what that means is that the market at least perceives, it's not our perception, it's not anyone, it could be anyone's perception out here, it's up to you guys, but basically the market is perceiving that whatever's happening here is going to be short-lived, and it will sort itself out in terms of reducing the price. Is it higher than it was weeks ago? Yes, but they're not expecting the contracts themselves to be $120 a barrel by October of this year. So I guess that's important whenever you're looking at this. And I think most people aren't aware of this, especially in the retail side. So hopefully that helps and makes it valuable for you guys to come and have a look at this today. Some other notes to say, whenever you're looking at all of this stuff, it doesn't necessarily mean that there's a trade. So just because there's volatility doesn't necessarily mean you have to place a trade. A lot of people feel like they have to chase. I think psychologically, that's a big component. I always say do the reps. So what that means is that you want to be looking at, can I do it consistently? So a good little rule of thumb, guys, and this is something I heard years ago, but I think it's very timely right now, is that if you think about, let's say I draw this on a handkerchief or draw this on a tissue or paper or whatever. If you think about your trading style, what are the most important things realistically to being successful or doing better in trading and investing? And you might think it's risk management. Okay, risk management's pretty important. There's risk management. You might think it's your trading system. There's no doubt trading system is really important, but ultimately it's psychology. And your own psychology actually makes up usually whether you'll be successful. And it always takes me back to that Warren Buffett quote, which is that temperament is the most important aspect of success in trading and investing, because of course we are always faced with two of our strongest emotions, fear and greed, in markets. So it's the one great equalizer. So really your own psychology often does have a huge impact into your success. So I think that's a huge little thing there that I want to share today as well. In terms of other markets, you know, the US 500 was certainly the impressive one in terms of it rallied as much as it did, but it has hit what I think is a critical level now, being that weekly 20. So I'd suggest you go and have a look at that if you're coming in right now. And we also want to be watching yields as well. So you can see here things like the 2-year yield, it hit to that critical resistance. We haven't seen this level broken yet, so we don't know if it's going to do that, but this is suggesting, of course, what most papers have been writing, which is that stagflation could be coming. Not necessarily believing that. For anyone that doesn't know, stagflation is where you have increasing inflation and declining growth. So that's why, I mean, you can see why that's the strategy that a lot of people think of right now, but they're very difficult to trade off that strategy instead or invest. You're better off just basically saying, where are the flows moving to? Some interesting concepts that have happened over the last couple of weeks. We've seen large activity in some of the sectors that have been hated for a long time. One of those was the software sector, again, just showing technology, technicals kind of working out. Everyone will be able to see huge volumes over here, obviously a multi kind of year low, and then a reaction off that low that was quite aggressive with volume. So again, where do these tend to go? Well, technicals really make you want to have a look at it and say, okay, well, if we're looking at these markets, then we have to look at what's happened before. And we can see here that it's not that consistent on the 20, but the 20 and the 50 have been kind of dynamic resistances or supports a little bit along this line. So therefore, if the markets do rally enough, it's possible to go to these levels. Again, it's not a solicitation to do anything. It's just possible to go to those levels. So it's just interesting to see these basing structures and to see software and Bitcoin both kind of finding some support. Again, goes back to that, in times of uncertainty, often markets will travel towards the sold off stocks or the sold off markets to kind of find what you would call safe havens. And those safe havens are just because it's already fallen a lot. It doesn't mean it can't fall more, but that's the explanation generally that comes through. Some other technical reads that you want to be thinking of around this time as well: anchored VWAP. Probably anchored VWAP might be worth bringing into some of your charts. If you're unfamiliar with anchored VWAP, you can get it inside the TradingView platform, and you can activate it by usually clicking here. And then what you're doing is you're basically saying, okay, do we have a critical low or a critical high? And you want to put your anchored VWAP on those levels. And this way, I've obviously said it wrong, but you might put it down here, and you might say, okay, well, if the markets keep rallying, and I believe it's a real rally for whatever reason, sometimes when it comes back to that anchored VWAP level, it can be an okay zone for you to be looking at your system and seeing whether there's it's like a dynamic support or resistance at around those zones. So some pretty good stuff there as well. Good question there from John today, and obviously a lot of volatility out there. I think that does create opportunity, but what I would really say to most people out there that are watching this is, have the patience to say, can I replicate that? Don't necessarily chase. I think oil has demonstrated the problems with chasing potentially over the last 24 hours. They are some of the wildest moves I've ever seen on oil myself, and I got into trading and investing before the global financial crisis. So really, you've got to be careful out there with everything you're looking at. So risk manage. Volatility doesn't necessarily equal excellent trades. It just equals a lot of up, down, all around. So just remember, stick to your guns and stick to the levels that that you've found have worked with you, and I think that's one of the best things to do in these times. And also go back to basics. What happens in times of volatility? Money will often go to what's considered the safe havens. So often in currencies, the Swiss franc, sometimes the Japanese yen, the US dollar, sometimes gold. The US stock market tends to get better inflows than the other markets around the world. You can see here the German market's fallen off more than the US market has. So this fell off 10%. And whereas from the highs, whereas of course, and again, all of them kind of hit critical levels. Again, massive supports being hit, but that is pretty normal. Money will often go back into the US first, and that tends to be that hidden latent demand. Guys, thank you so much for joining us. We hope you enjoyed another live session here with Pepperstone, and we will see you, of course, in a few weeks' time. If you are interested in subscribing, make sure to do so below, and I hope that you got some good techniques and ideas out of today's session. Keep it basic during times like this, and of course, go back to looking at the major levels, because volatility, just like that, can get you to those zones. Thank you so much, and we'll catch you soon. Bye for now.